Hi everyone, it's Stuart here. Audio doesn't sound very clever. Let's just check everything's okay. Mary had a little lamp. Yep, looks okay. Output fine. Yep, okay. Just doesn't sound very clear in my headset, but hope everything's okay. It should be. Today, it's Monday, the 17th of February. US markets closed today for President's Day, celebrating initially, well, it's sometimes called George Washington's birthday as well, but recently changed it to President's Day. So celebrating all previous US presidents, including obviously the current incumbent, number 47, 45 as well, wasn't he? But, anyway, not a lot of action out of Washington over the weekend because he was down at Mar-a-Lago, presumably. But Europeans in a bit of a state emergency meeting. Starmer's been UK Prime Minister Starmer's been invited to a European summit in Paris this afternoon, convened by Macron, looking like they are going to sort of mess about with budgets, and actually it looks like they're going to actually Trump basically getting his own way and up in their spending. Obviously, the major issue is their apparent side, or they're feeling like they've been sidelined by the Trump move to try and normalize things with Putin. That's just amazing. But anyway, let's see how we go from here. Obviously, he throws a lot of stuff at the wall, does Mr. Trump, and let's see how much of it actually sticks. Anyway, enough of that. Today, we're going to go through a couple of strategies I didn't have time to the other night when we were looking at swing trading. So those of you that were here that watched the first one, if you missed the first one, I'll do a quick review of the strategies we talked about then, and we'll look at the two new ones as well. So if you've got any questions about anything, obviously stick it in the chat box. Let me just check. Stick it in the chat box, and we'll have a look at it live if you like. We'll obviously go through some slides, but then I'll use some live charts to demonstrate what we've shown you in the slides. I've got a false background on today. I hate using false backgrounds, these blurred backgrounds, because I'm actually had to move out of my home office downstairs. My Wi-Fi, God bless Linksys, is playing up. So I'm plugged directly into the internet downstairs where it comes into the house. I should have gone into the office today. But then, anyway, there you go. That's the joys of working from home. Anyway, let's crack on. I've enough of me leathering on. So today, swing trading strategies 2. We're going to quickly review what we did last week as well, and then we'll get on to the two main ones we want to talk about today. So swing trading, what is it? You don't want to talk about me. So we're going to go through quickly what we did last week. You know, these what makes a good swing trader, the key things about liquidity, the time framing, having a system. The three we talked about. Do we talk about 3? I thought we talked about 4. I'm sure we talked about 4. Anyway, going mad. The 3 we talked about, simple moving averages with an RSI, the parabolic SAR and the MACD, and the crossing EMA strategy. And then today we'll highlight how to trade swing trading, the particular technique with Bollinger Bands. There's lots of ways to use the Bollinger Bands. We're going to concentrate on sort of the ziggy-zagness, the continuation type approach using the Bollinger Bands and the midline on the Bollinger Bands. And then same with Fibonacci retracements. Key 3 levels on the Fibonacci level we're going to look at today. If you don't know what these indicators are, or they're new to you, I will do some sort of background to these indicators themselves, but I'm assuming most of you have heard and have used these indicators before. Again, if not, let me know, but I'm assuming some sort of level of understanding with regard to what these indicators are today, but there'll be a brief explanation of what they are as we go through, but nothing in any particular detail. Remember, there's nothing free in this life. I'm here to help. We're all here to help. But there's no holy grail. There's no point in trying to use lots of indicators or only a few indicators, tweaking them and changing them over the times. It's all about understanding yourself, discipline, skill, and hard work, basically, and just accepting, you don't win every trade. You lose a lot more trades than you think you will. It's all about your mindset, and it's all about when you do lose, accepting it and keeping it small. And when you win, let it run. Give the market time to move in your direction. So don't get out too quickly unless your stop loss has been hit or you're uncomfortable with the trade that you're in. So swing trading is basically, holding a position typically 1 to 3 days, sometimes longer. I've held swing trades for weeks, to be honest. It's basically capturing the impulse and the retrace, the ABCs, the 1, 2, 3s, call it what you will, the M formations you see on charts, or the W formations, the head and shoulders, they're types of swing trades as well. It's just a way of capturing market moves, basically. And obviously, no market moves in a straight line, either up or down. And remember, markets tend to consolidate, tend to go sideways for most of the time. But when they do move, when they do trend, they can run and run and run, like we've seen in the stock markets since the great financial crash. And really, the gold market is a great example of a more, just since the beginning of the year, it's absolutely rocketed higher, hasn't it? So, trends can run, but they never run in a simple straight line at any one time. So that's the nature of swing trading. 3 key things: liquidity, timeframes, and having a system, having a strategy. So you want something that's liquid, you want something that's moving around. What's that? When people say liquidity and they talk about liquidity in the market, it's just basically that. Imagine a liquid. You want something that's flowing around, moving around. Okay, you want something that's moving. If something's stagnant and still, the pond dies, doesn't it? It runs out of oxygen. You want, the river to be moving. You want, and if you're using the river analogy, as I've just done there, you want to be going. It only goes in one direction, doesn't it, a river? So that's a trend for you. You want to be following it down to the sea as the river gets bigger and wider. Obviously, slows down a bit as it gets into the floodplain, and then zigzags around a bit as it runs out of steam, and then it finally hits the sea. But you want to catch a moving market. And that's why you want liquid markets. Stuff that's illiquid, things that aren't moving around, it's just a friction on your profit, a bit like commissions or taxes or charges for trading. Find liquid markets, find volatile markets. Everything we offer here at thePropTrade.com is a liquid market. Some are more volatile than others, some trend better than others, but there's money to be made, obviously money to be lost as well, unfortunately, in all markets, whether it's Forex, commodities, index markets, or crypto. There's opportunities all around. So typically, swing traders use the daily time frame. That's what we're going to divert to. That's what we're going to use as our default position today. But shorter time frames can be used for setting up exits and entries. But you can also swing trade on shorter time frames as well. So it's not something for intraday traders or long-term investors. It's not those that are looking to catch a quick return to the average or return from an overbought or oversold position on an intraday basis. But it's more of a 1, 2, 3 day, week, monthly potentially. Very much the trend is your friend. You're trying to find a trend, whether it's this underlying trend, i.e. you're with the higher time frame trend. This is what you're looking to do, ideally, or you're aware of the higher time frame trend and you're just trying to catch a retrace in the higher time frame trend to a key support level, typically, or key resistance level. They seldom fight it, and if they, as I say, they go with the trend typically, but swing traders tend to not go against it. Or if they do go against it, they're well aware of they're going against the higher time frame trend when they are taking positions in that direction. So it's this idea of moves within moves, so cycles within cycles, moves within moves, trades within trades. So the big thick one is the monthly trade, say the monthly trend. It's going up all year. The mid one might be the weekly, and then the skinny one that's wrapping around both of them is the faster moving daily time frame. So it's really what we're looking at for swing traders. And as with any approach to trading, this mantra is this statement is true, whatever it is. Have a system, whether you're an intraday trader, a swing trader, scalper, it's applicable for all positions, but particularly for swing trading, you have to have the system and you have to let it run. So have a system, trade it, follow the rules, stick to the rules, accept your losing trades, bag your winning trades, make sure your losers are smaller than your winners, and you're in the money basically. You do have lots of long-running winning trades. You'll have a lot of long-running losing trades. It's just part and parcel of what we do. But if overall your losing trades are smaller than your winning trades, you'll make money. Most strategies, most systems, most approaches win enough. It's the application of the individual trader that tends to catch them out. And that's really what people don't focus on. They focus on trying to find the best system, or what's the best time frame to trade, or I only want to trade gold, or I only want to trade indexes, or I don't understand why sterling's gone down when there was good news this morning, blah, blah, blah. It's just, you're beating yourself all the time. And that's the trick to any type of trading. And I said, particularly swing trading, because you've got to let the thing run, get it a bit of air, a little bit of time to either prove that it's not worked or prove that it is working. Okay, don't get out too quickly, except when you're losing and it's heading towards your stop position. So a good swing trader understands technical analysis, understands price action, can identify a trend when a trend is over, when a trend is slowing down. They tend to go with the trend. Although I've talked about, trying to trace the retrace, trade the retraces. They will look at the higher time frame trend, typically daily or weekly, as I said, and go with that trend. They can differentiate between a retrace and a reversal. This is the difficult thing, this fourth point here. What's the difference between the two? Well, you'd never know until it's completed. A reversal is the trend is over, it's finished, it's turned around, it's broken, and we're going in the other direction, or we're in an area that occasionally happens, but mostly we tend to consolidate at a level, or we cool down, we go sideways. We're looking for mean reversion trades for a day, a week, 6 weeks, whatever it is. We'd see that with the Bitcoin market at the moment. Good, another sideways week last week. So it's waiting for some direction. It's waiting for a breakout, whether that's up to the upside or the downside, nobody knows. But the bias is obviously to the upside. But we've had a really, really good run since the US election, haven't we? So Bitcoin just waiting. They understand candlesticks and patterns and formations. They don't get too hung up on them. They don't get too focused on particular perfect setups. But they do understand technical analysis. They understand the significance of the body of a candle, or the wick of a candle, or the patterns that are formed, and whether that's bullish, bearish, or everything's in balance. The buyers and the sellers are in equilibrium. So basic stuff. That's what makes a good swing trader. Patience and discipline is really good with all sorts of trading, as I say all the time. And again, particularly with swing trading, because you've got to let the thing happen. Make sure you've caught the turn. You may not have caught the turn. You may have put a Fibonacci level on. And in fact, it hasn't turned. You've misjudged it. We'll talk about Fibonacci in a minute. But that's what makes a good swing trader. My humble opinion, it's just my opinion. But as with all trading, find what works for you is the most important thing. Back test your system. There's lots of free sites now. Obviously, some really good sites you can pay for their software. Understand the indicators that work for you. Whether it's trend lines, fib levels, oscillators, whatever it is. And as ever, accept your losing trades, manage your emotions, and it's always about risk management as well. Always. If you're going to be successful, you want to stay in business for any length of time. And that's the first principle. We had our end of day trades that I put up on the Discord group. We had a bad week last week. I haven't actually updated them yet, but we had a bad week last week. But that happens. You have losing weeks, you have losing days, you have losing months sometimes. But at the end of the year, how have you done? Or at the end of 5 years, how have you done? At the end of 5,000 trades, how have you done? That's the big picture. That's what you've got to be most focused on, looking after that equity curve of yours and not having too many peaky drawdowns on it. Okay, so swing trading, Is it for you? Well, it's really all about your personality. That's what I think makes a good swing trader. So you tell me how you go. Last week we ran through, I thought we'd done 4, but perhaps we only did 2, 3. We looked at 3 simple strategies. We looked at the moving average and the RSI combined. We used a 7-period simple moving average with a 7-period RSI. We reduced the RSI down from the typical 14 to 7 to create more overbought and oversold positions. And then we also pulled in or pulled up or pulled down the overbought and the oversold area to 65 from 70 for the overbought area, and we brought it up from 30 to 35 from the standard setting for RSI to create triggers. So basically we are looking to, if we're going to go long, we'd like to see the candle, the finished completed candle on the end of day, typically above the 7-period moving average. And then we'd like to, the next trigger is the RSI moving out of an overbought area, oversold area through the 35 position. First entry at the break of 35, second entry at the break of the 50 candle or 50 line on the RSI, and then run it till we went into the overbought area, or the market returned and took us out as we were trailing our stop loss up, because we trail our stop loss up with this strategy, counting typically 5 candles back for the first entry and 2 candles back, much tighter for the second entry, and then run it. So this is basically looking for turns in the market. So it's trend following turning market swing trade type approach. And the charts looks a little bit there we go. That's what I've just been said there. 2 stop exit. So the chart looks a little bit like this. So you can see here the candle is broken above here on the 21st of February above the 7-period moving average. That's a single to entry. Also happened on that same day as well. We've broken from below the oversold area to above it. So we enter here on the opening of that day, and our stop loss is 5 candles back from our entry candle. So if this is our entry candle on the second day, if we didn't enter on the night before, it would be down here underneath the low of that wick. Happens to be on the third candle, but you get the point. We've seen how the market sort of turned. The second entry, if we're using 2-position entry here, would happen at this point here on the 25th, so a few days later, entering on the night of the 25th or the morning of the 26th. We had a second position with our stop loss much closer though. So the stop loss on the second position is only 2 candles behind, not 5 candles behind. And it would be here at this point here. The next slide shows you that. There we are. So you can see that's our first entry here. So that's our low point, wasn't it? That wick point there. And our second entry point here on the 26th with our 2 count back, the red line. So as the trend unwinds, you don't know, obviously at this point, this is looking pretty good because we've got in twice. Sometimes we break the 35 and we don't, we never get to, it doesn't get to that, and it turns back down and we get stopped out as this rolls back down this way. Here we've got off to a good start because within a couple of days we've got a full position on. We got the initial stop loss there and the second stop loss just here at the second red line. So as the days move on, as the trend unwinds, we don't add to our position at all on this one. I mean, that's a money management technique. On the size of the candles, I would tend, that's another story for another day, but I would be adding more on the big candle days as this trend has confirmed it's unwound. But anyway, let's keep things simple. So we're fully loaded after the break of the 50 period. Here, a few days later, we go above and into the overbought area, but we stay with we don't get out because we've gone into the overbought area. That's not the point of this. We're looking to come, we want to be short when it comes out of the overbought area is how we're using the RSI here. So what we're doing is just let the market dictate what's happening. We've been coming down here. We've flattened out. We've got some big candles here on the 27th and here on the 2nd of the next month, 2nd of March as it was. And even here, the following 5th of March, big strong candle, huge strong candle here, which happened to be the top of the market. We didn't know that then. We went to 140 plus or something here on the 9th of March, many days after we've got in. So we're nicely in profit. With our stop losses trailed up behind us. We got in down here and then down here. So we're in a winning trade. So we'll just let it run. Let the market tell you what's happening. And our tight second 2-candle trailing stop loss from our secondary gets stopped out first because it's tighter, obviously, and then our 5-candle back, doesn't get stopped out there after the market is turned down, and we exit our first position. It says second position, but that's our first position here on this blue there. You can see because we've given up that, but that's the rules. We're 5 back from the high as the market has moved up, so we trail it up. So it's a trend following swing strategy. You can see, and we've taken out the meat of that move, and that's really what you're trying to do, and that's what most swing traders are doing. You'll never get in right at the bottom. I mean, we happen to here on that example there, but that's a very strong trend. Went on for 12, 14 days, and you never get out at the top. But you do take the body of the move, the meat of the move, and that's what we've done here. Quite nice on this demonstration here. So that's the 7-period moving average with the RSI set at 7, and our overbought and oversold areas pulled in from standard from 70 to 65 and from 30 to 35. That's our first one we did last week. Okay. Next one is the one we have on my default charts all the time, and that's the parabolic SAR and the MACD. Parabolic SAR, little dots above or below a trend or below the price action. If the dots are below the price action and the price action is starting to move up, that's a suggestion of a strong trend. If the parabolic SAR dots move above the price action, that means perhaps we've been going up quite nicely. That suggests that the trend may be slowing down or cooling, or it's having a pause, or it may have turned and we're going down. So it can be quite choppy, the parabolic SAR, the PSAR as some people call it, but it stands for stop and reverse. That's what it's looking to try and identify when the trend stops. But you want a nice consistent row of dots to show that the trend is going. The slow moving, more lagging. Well, it's not more lagging, but the slow moving MACD gives us a way of taking out the choppiness of the parabolic SAR. So you're using a combination of the two. How to read with this strategy is that you use the MACD signal line and the MACD line as the initial signal, whether they cross, whether you're going long or you're going short. Obviously, one's crossing above or the other below. You can see from the chart whether you're going long or short, and then see if what position the parabolic SAR is. It's likely that the parabolic SAR is already flipped or is already in agreement with the cross of the MACD strategy. Sometimes it isn't. Sometimes they cross on the same candle, but that's the two steps you're looking for: a cross of the MACD line and the signal line, and the parabolic SAR dot being in the corresponding direction that you want to go. You then run that until one of those situations breaks down. It's typically the parabolic SAR flipping first. So we use the choppiness of it to make sure we get out a bit nearer the top of the range. However, you can still then get in as a continuation trade if the MACD and the signal line are still in trending either down or trending up, because the parabolic SAR could then flip again back to your direction. So you use the choppiness to try and the parabolic SAR to try and guarantee a bit better run. Let me just show you that on a chart here. So this is from my old MT4 platform. You see here they haven't got the signal line and the MACD line on the default setup on MACD on MT4, but you get the point here. You can see that the here on this first yellow line, you can see the parabolic SARs of these yellow dots here, and there's the difference between the signal line and MACD line here is the difference between the histogram and the red signal line here. So you can see here the histogram is inside the signal line here, and the parabolic SAR flipped a candle a day earlier, but the following day here on the whatever this was, the 25th of February, it's flipped, and so we're long at this point. So we're long from here. We trail it all the way up until the parabolic SAR. You see, the parabolic SAR was we got right to the top. We turned around, and the parabolic SAR flipped here. So we got in here and out there. So that's a nice positive long trade. And also, yeah, we got out here at the blue arrow. Parabolic SAR is flipped again, but we're not inside the signal line yet. We can't see the cross yet on here, this one very well, until we get to 0.3 here. And that's when we take a short position on, in fact, it would have been there, I think, wouldn't it, at the end of this candle here. Because we're now, the histogram, you see, sorry, the histogram is now inside the signal line here. Parabolic SARs are up here, negative. And again, we move down, and then we trail our stop loss down as the trend moves on. Then we flip again here at number 4 and move long, but that turns around quite quickly, and then there's a lot of choppiness and failed. You see the idea that when we're flat and horizontal, we get this choppiness of the parabolic SAR flipping around. There's no direct trend, but then this last point here, we've got a break here, a flip here to the downside. So we get in here, goes against us initially, but off and running here, and then it's flipped finally here. So it's 3 big positive winners and a couple of losers as we've gone across here on that chart there. So we're using the parabolic SAR and the MACD across of the MACD line. Let me just it's the old ones. Let me just show you on the my standard. If you weren't here on the other day was my mouse isn't working very well here. Sorry. You can, if I just put up the, I'll come back to this one in a minute. The MACD. This is what it looks like on our trade locker. There we are. You can see that much clearer there. And this is the 5-minute time frame of the day, but you can see the rules are still the same. There's been a there we are. We had a cross there. Interestingly, that's gone down, and that's you got in there, and that's gone against you. So that hasn't actually played out there. That one would have been successful there. You can see that one there. That's that last one there. We got a cross of the signal line and the MACD line here on this. So we get here's, I'm talking about daily as a swing trader, but you can use this on a shorter term time frame. That previous one didn't work out, but that's a nicely positive one. See how the MACD and the signal line are still in alignment and going up, and the parabolics are sort of flipped here. So we'd have got in here, got out there as it's flipped over, and then got back in here because the MACD is still going up, and we haven't yet flipped on the parabolic, so it looks like it might do. But that's obviously just a 5-minute time frame. If we look at the daily time frame here on that's a really good example, because we just had a monster rally, haven't we? And there we go. You can see that was a flip down, and that was actually quite successful. Then we flipped up here. So the parabolic SAR's flipped there, but we haven't had a cross of the MACD until this top here. So we get in here, it goes against us for a few days, and then it runs and runs and runs and runs. We get out on that day and then get back in again here on the 6th of February. And again, we haven't looked back on that as it's rallied higher. So it keeps you in the trend. That's what swing traders do. Initial trade, out, consolidation, back in again, because we're still in alignment here with the MACD. Okay, so that's a swing trading with the MACD and the, oops, I've gone too far. MACD and the parabolic SAR. Next one, again, I use it a lot on my default settings. We're using 3 moving averages, exponential moving average this time. The 3, the 5, and the 21, and we're just looking for a cross. So we've got the short or the slow, the medium, the fast, or the long, the medium, the short, depends on how you call them. But basically, we only go, the key trigger is the 21 exponential moving average. So we want them all in alignment, means they're all got to be in the right order. And when they're not in the right order, i.e. the 3's crossed over the 5, we get out, we're flat. Okay, so we're looking for strong trends. Obviously, the choppiness or the laggingness, really, or the delay of the EMAs means you can get in after a move has started. So it's not great for timing, but they're great for keeping you in particularly long trends, like we just seen there on the DAX on our platform. And I seem to have lost the DAX. No, there we are. So that's the DAX with the parabolic SAR set. If we just flip it back to the moving average setup, this has got 5, 9 in 21, not 3, 5 in 21. As I've said on the slides there, but you can see the principle is exactly the same. We're looking for the crosses of the moving averages, the red line being the 21, the 9 is the green, and the orange is the 5. So let's see here, orange, magenta for 21. So there we go. We kept in, out, and then back in here as we've gone back over the midline one, and again running, trading our stop loss up, and again, either with 3 or 5 stop losses behind. This is the big 22,000 level here on the DAX, so it doesn't show any sign of fading. It was we're back up. We're over 22,800 today. We were over. We broke 22,700 for the first time earlier on today. So running is the DAX. Despite everything that's going on in Germany, obviously German elections on Sunday, expectations of big spending on defence companies, and many of them sit in the DAX as well. Some of the steel companies in Germany. Anyway, that's the principle. So when they're that's a great example of a very, very successful period here. Less so because we've gone short, but then nothing's really happened. So when we're flat, when we're going sideways, moving averages are no good. We're not swing trading. That's what we're looking for, aren't we? We're swing trading for turns in the market. Like we had a turn here and down, and then a turn here and up. And then all this period here was just blah, 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 blah. And that's exactly what we've got with Bitcoin. Those of you trading Bitcoin, we've got very much a sideways action, not a lot happening, but still, I would argue, still biased to the upside. So that's the moving average setup. Let me get my slides back. Where was I? Slide is here. So the 3, the 5, and the 21, or as I've got on that one I've just demonstrated, there's the 5, the 9, and the 21. But it's all about the alignment. This is the key word here: alignment. They've got to be in order to show that the trend is set and it's running, and we've got in, and we just again trail our stop loss. We go with the swing until the energy of the market runs out. Sometimes you see that with the smaller candle bodies. Sometimes you see the wicks disappearing. Anyway, we're over halfway, and I haven't even started the new ones yet. Sorry, I do prattle on a bit too much. So that was the swing trading one. And the two ones we're going to talk about today, we're going to look at Bollinger Bands and Fibonacci levels. And I've lost my drink. Here we are. No. So there's lots and lots of ways to trade with the Bollinger Bands. This one, I'm talking about a continuation type strategy. We're looking for a touch of the outer band and then a retracement to the middle band. Bollinger Bands are basically measures of volatility. There's all sorts of other things you can do with them. If they're sloping, that means it's trending. If they're flat and horizontal, means the market's going sideways. There's not much volatility. When the bands are very, very tight, when the bands are very wide, there's lots of volatility. Lots of big body candles or lots of wicks on candles. Captures all of the price action, or 97.5% of the price action is captured within the Bollinger Bands, these two standard deviations from the mean. The mean that John Bollinger created was, he used the 20-period simple moving average. That's the middle line. And then the deviation from that average, two standard deviations to the north, if you like, positive or two standard deviations to the south negative, captures that range, captures 95. I said 97.5, didn't I? It's 95% of all the price action. So people use them, when they're outside the Bollinger Bands. Oh, that means it's got to retrace. Normally, yeah, probability is on your side, but sometimes we can stick to the outside of the Bollinger Band for a long time. We get a long positive trend. What we're doing today with them, with this approach, is we're looking for to look at where is the trend? Are the Bollinger Bands sloping upwards? Are they sloping downwards? Is the angle of the slope a nice sort of 40 degree, 45 degree, 35 degree, not too flat, not too steep, sort of a nice sort of chart angle? If so, we're looking for the zigzagness of the move to be captured. So we're looking for a touch, a retrace, and then we go. So we're looking for that tick action. We're looking for that impulse and reaction is what we're looking for. So the trend divided by the moving average, so a touch of it, are we above it or below it? So the line is the midline, the 20 period moving average. And when we return to the moving average, and then a move back in the direction of the trend is what we're trying to do with this particular use of Bollinger Bands. Okay, so if the price is below the 20 period and we got a sloping down, the angle indicates how attractiveness of the trend. We're looking to sell it if it's moving, if it's angled down. We're looking to buy it if it's moving up and it's touched the outside and come back to the middle line. That's what we're looking for. We want to see the price action pull back to the middle area to initiate a buy or initiate a sell if we're in the middle. Let me just demonstrate. That's probably easier than just read those words. As we're already 40 minutes in. Okay. I'll come back to this slide in a minute because the pinch, the pull in is really, really significant. So we use the outline, the move to the outer band as an exit. If it's sort of what I'm saying, standard, a fairly typical width on the Bollinger Bands, use this as an exit and then see if it happens again. However, I'll come back to this slide in a minute because the pinch doesn't happen very often, but when it does, it's very, very powerful. I will demonstrate with some live charts. This is a static chart, but you can see what's going on here. So let's start here. We've been moving down. We're in the under half of the Bollinger Band, so we're looking to go short at this point. So the dark black candles are negative candles, the white candles are positive candles here. So we moved down. We didn't touch the Bollinger Band. Then we had a big breakup reverse, huge bodied candle back over into the upper half of the Bollinger Band. The Bollinger Bands have pulled in a bit, but it's not really a pinch, is it? It's a squeezing of the Bollinger Band. So this is our first indicator. So we've moved up. So our first touch of an outer Bollinger Band happens to be the upper Bollinger Band. So we're above the 20 period moving average, the medium, the average on this. So we're looking to buy when the price touches. And again, with this, we're not waiting for the candle to close. We're just waiting for a touch of the extreme that we're trying to trade here. Okay, so that's our first signal. Dink. So this happens to be a daily candle as well. So 1, 2 days, we still keep going up. The third day, following our first heads up, we have a huge down day and move down, and we close the day down. But more importantly, we touch the outside of the you touch the midline. So that's our buy signal. So we buy at this point on the touch of this midline. So what you can do with this strategy is set up an alert that scrolls higher with the 20-day moving average or the 20 period moving average, knowing that this has already happened. So this has happened. We've got in here, and again, very, very simply, we're looking to get out because these are fairly standard distance. It is widening. The candles have got bigger since we started, 2 big ones, and then we had a big one that took us out on our profit when we touched the extreme of the band again. Okay, but as you can see here in this strong uptrend here, we've been outside of the Bollinger Bands like on that day, 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 on that day. So you can see it's too simple to try and put a short position on once you see a touch of the outside of the Bollinger Band. Many people naively assumed if 95% of all the price action is then closed within the Bollinger Bands, it's got to go back down simply because it's gone outside of that 95%. So yeah, it needs to be used with a bit of understanding the Bollinger Bands. So anyway, so that's a successful trade from here to here, and we're out. But again, so now the rules are still the same. We've touched the outside, so we're looking for a retracement. Whoops. A retracement back to the 20 period, the midline. So we do that and we hit it. Okay, so we buy on a break of here. Oh, sorry, my candle's a bit too close. So we buy here at this point here, but again, a bit like we have with the extremes here, the 20-day moving average here has provided support. And what are the candle bodies and candle patterns telling us? Well, they're edging up over that 4-day period, this 4-day period here, but there's no significant direction. There's no big bodied candle, is there? So there's clearly the bias is still to the upside. The moving average is sloping up. The Bollinger Bands are sort of angling up. You see the angle on them, nice. It's a nice 30-40 degree angle as we're moving up for 1, 2, 3, 4 days. So we've bought down here. But there's an explosive day, the 5th day here after we got in. Massive day, okay? Again, it depends how you'd set this up, but this is the rule about the pinch. I'll go back to the previous chart. So we've had a pinch here, a very significant pinch because of the size of this candle. And again, most traders, and I've done it myself, you wouldn't, having done nothing for 4 days and having had 2 big down days in the same sort of 10-day period, a massive up day like this, you think, I'll get out. And, that fair enough. You would have made profit, obviously, on that, and quite a significant profit because we've hit the outside of the Bollinger Band. But the key thing of this pinch, I just want to bring you back to the pinch, is that the move can be quite significant. It tends to go on for 3-5 days thereafter when you get a big candle like that. So that's what I'm saying. The pinch, where the upper Bollinger Band moves down and the lower Bollinger Band moves up, creates a pressure. And that's what, think of it as like a balloon pushing it in, and it sort of, you push it in, the pressure of the price action pushes it out. So when there's a pinch, the trade is potentially explosive and it can move very, very quickly. So, keep your stop loss up there to keep you in. So here you can see standard trade you would have got out at this point, but because you've identified the pinch, see the pinch happened not exactly on the same day, one happened after the other, but it was confirmed on the day of this candle. So if you hadn't have exited on that candle, you would have got a few more days of profit before it turned around and you got took out here, because you can see if you were moving it up the low of the last 2 candles, you would have been took out as it turned around here. So again, we've touched the outside. We're looking for a retrace. We've got that this time. It retraced, but then we retraced, but this time we've broken back through it. So, it doesn't always, the trend now has started to ease out. We've flattened out. These Bollinger Band upper line wouldn't have flattened out until we've, completed these 3 or 4 days here. But we're now back under on the completion of this day here on the 8th of January, whenever it was. I didn't realize that was really today. It was end of year volatility as well there. Just happened to be, I just looked at the dates there as well. So that's obviously come into play as well on this one. And then we flattened out as we started the new year on that one. So it's catching that ziggy-zagness of swing trading. You can see here. So we basically, and again, you never catch the bottom to the top, but we've got from here to here. Let's retrace again. Now we've got in here and out there. We've got in here and out there, or even higher up if we've followed the pinch rules. Okay, so many people trade the Bollinger Bands, from and stay with it until it tracks to the other side of the band itself. That's a way of doing it. Others add either a third moving a third standard deviation, so they capture more of the move, but really react. It doesn't happen very often, so you've got to have massive amounts of patience and not using the 2. Others put in a 1 standard deviation and use a similar thing to trade in between. There's lots and lots of ways to trade with the Bollinger Bands. I really like them. They've been around a long time. John Bollinger is a really nice guy as well, just to top it off. Anyway, there we go. Bollinger Bands, swing trading strategy number 4. And finally, we're going to use fib levels or fib retracement levels. Fibs, again, one of my favorite indicators. I'm not going to go into the background of Fibonacci today. I've only got 10 minutes left, 15 minutes left to wrap up. But it's, Fibonacci is great, and the Fibonacci retracement trades or positions can be quite self-fulfilling. But the trick with Fibonacci is to make sure you don't put them on too early. Make sure the trend is over. So you need a good trend, determine a good trend, and you need a clear, I've thought clever there, it should be clear. a cleaver change in direction. Apologies for my spelling. If you're all awake still. In direction. Now here, I'm using the 3 key levels. The 3 key levels on the Fibonacci: the 38.2, the 50, and the golden ratio of them all, the 61.8. The golden ratio of Fibonacci traders. If you don't know what I'm talking about, golden ratios and Fibonacci. I'll do a little explanation of Fibonacci as a separate training exercise as well. But we're looking for the support and resistance levels that these key levels provide, and then we're going to stick an oscillator on it to give us our direction and a second indicator. So here we're using fib levels and an oscillator. I'm going to use the MACD here. It doesn't have to be the MACD. You could use the stochastic. You could use one of your, another oscillator. I'm just using the MACD here again. So we're using the MACD and the fib levels to create a potential upside move. So we determine the strength of the direction of the slope. You can put a simple moving average on there. I'll use the 20. I'll use an example of the 20. It could be the 20, the 50, whatever it is. Again, to give you an idea of the slope, but you can probably tell just from the price action itself. And we're using the Fibonacci levels once a trend is finished, and that's the key issue. You've got to make sure or be comfortable with yourself that the Fibonacci level is over, and then see how these levels play out as we look back to the previous price action, what's happened before. So, and then use the overlay of our oscillator to tell us where, what's a good position to be in, i.e. across of the MACD signal and line, across of the 0 line if you're using the MACD, or across of the stochastic lines, whatever it is. This example, I'm using you're going to also add the ATR to. Hello, what's happening here? It says, hang on. Are we all still here, my friends? Let's have a look. I've just got a little video. Should be that one, not the one's not working, surely. Okay. That's what was going on there. I'm using the ATR to create the stop. It's a bit more complicated here because you've got to do a little bit of maths. I'm using the ATR. Again, I've changed it from the default 14 down to 10, and I'm using 1.5 times the ATR for a stop. Some use 2. Again, it's just how this particular system is set up. So let's have a look at that on some charts, and I'll bring in some live charts as well in a minute. Okay, so again, this is the default white chart. So here has been our main level. Again, so Fibonacci, we're looking for trends. So we've had a major down leg there. The last leg, as we've come onto here, has been a positive leg, hasn't it? From this floor down here at 148 to whatever it happens to be here. So that's our major fib level from there to there. There's a second one put on here from this little level here, and we've got a bit of a cluster, but just ignore the light blue lines. Let's concentrate on the main thick blue lines. So the 20 period moving average is the green line here. So we're clearly in an uptrend. So how much of a retracement are we going to get? Well, the 50% move of this last leg here, the blue, sorry, it's that blue leg there, isn't it? I'm talking about, sorry, this last leg here, this one here. The 50% here is here, and that's smack bang on the 20% the 20-day moving average and the 50%, the blue, dark blue here, fib retracement level is sat there as well. So that's a key support area. So we could continue to decline from here down here. But as you can see here, we can't really put this fib level on here until all this price action has played out. So we perhaps could have put it on the conclusion of this day, so 3 days after we've rolled over. But try to doing it here at the top. We could have easily have gone up here for these 2 days. And again, we could still bounce from this level. This is a Fibonacci level that's still in play from a different leg at 38, so that we could, and it's a big round number, it's 1660. So it could still bounce off there. So, however, it has rolled over, and also the MACD oscillator has also crossed. So we'll be looking to go short here with a target at this first target at this this moving average and fib confluence here around this, where this green line says here for the 20-day move now. So that's a key target to the downside. Not a massive move, but still an $8 move on gold. It's still a significant move. You can see that's already happened. So again, the MACD has widened out and moved lower as the move has completed. The key with Fibonacci levels, my friends, is to make sure that the trend is over. Can catch you out. Here's a similar move. This is the big leg up here. You can see the I've got again, I've got two fib levels on there. I'll explain that in a minute. But the big 50, 38, and 61 level, the three levels we've in play here. So very strong move. Didn't retrace the 61 level. Didn't happen. We did get down to the 50% level before we bounced, and then we bounced to a retracement level, which is, again, you can see that we've rallied to the 61.8 of this last leg. So there's two legs here. What this chart is also showing is the confluence of fib levels, the coincidence of other fib levels on different legs. So we've got the major leg. So we've got the big impulsive move, and then we've got the retrace here. So you can see how the clustering we've got of the fib level. So we've got the 50 of this leg down here, this second leg down here, sitting alongside the first 22.3. So that's not less significant, but it's significant in this short term because it's a 50%, and the 61.8% was also hit of the second bounce up. So this big move retraced 50% of its move, but not for very long. So the overall direction is still to the upside, and that's what we're looking for, this extension here. So at this point here, it's positive. We've ran and retraced again, so this is still looking to go long and perhaps again hit new highs here, 120. Remember, euro at 120 back in July, October 2020. So using the actually, we've got confused things with the multiple fib levels on there, but you get the point. So that's the major leg, the big blue line, and that's retraced not to 38. Didn't stop. It did stop at the 50 level and moved up. Didn't get to 61. So that was key. Then we knew that was over now by the time we get here. So that's why we can put on this next fib level, like it did there, but then went down. So we haven't gone down any further. And then the shorter one there, and then a potentially shorter one there. So we get this confluence of Fibonacci levels, which gives the significance of the support and resistance levels added value, or added key significance. Now you can see how they're clustering together. The key one is this one here, the 15 and 61 of the blue, of the major blue moves here. Okay, so that's fib levels and oops, my old company on there on these charts. So similar. Let me bring in there's just lots of repeats of the same thing. So let me just bring in our charts again. Let's create that on our own trend blocker chart. So there's my charts. Well, my mouse isn't working because it's Oh, it's proper mat. So let's just create that for you. Now then, the DAX, for instance, it's a great, strong, trending chart, but we can't use Fibonacci levels on this daily time frame, simply because the trend hasn't turned around, has it? It hasn't stopped. We've had legs here, so we could put a fib level there, and it's retraced that. That's probably about 60. That's probably as a classic 61 type level retrace. But now it's ran and ran and ran. So there might be some extension levels on the Fibonacci level that we might play on. If I just bring in a blank canvas here. Was the ATR, wasn't it? So again, the DAX, you can see so there's the 20, it's positive, and we've got no sort of fib level. So I'll bring in something that's might be a bit more, I don't know, something, I don't know. There we are. So we can see. So you can see what let's do it with this particular asset. So you can see we've had a leg down. That's the major leg, isn't it? Down from top to bottom. And when you're putting your fib levels up, when you're going down, you got to start at the top and go down to the bottom. So what we'd be looking for here is these key levels. So I've taken the other levels off. So the 38, the 50, and the 61.8, the levels we're looking if this is going to go to the upside. So is it positive? That's what we're looking for. Well, the 20 period, so we've rallied from the bottom to the top here, and it's that's the first, that's our key one of our key levels of 38.2. So we've already hit that, but we're now bounced off that, we're below it, but we're still as we stand now, this is Aussie, just happens to be Aussie CAD on the daily time frame. We're looking for all the way back to October, so it's a big move. So this is still biased to the upside. This is telling us the MACD is saying nothing's happening. It's flat. It's run out. So it's a no trade basically using this particular strategy. It's not. It hasn't. It's swung from this low here, and then you see the MACD crossing there, back over the 20 period. So it's ran, but it's stalled at the 38, came back down, and it stalled at the 38 again and come back down. So that's a key. See how key that 38.2 now becomes the key resistance to this going up. So I'd only be interested in taking a long position here if we brought this 38. At the moment, it had a good day on Friday. It's having a good day today. So on a short-term basis, it's relatively positive. It's just happened on Friday. It closed positively over the 20-day moving average, but it's been under the 20-day moving average as well for a few days. It's a bit, we could have drawn a trend line. It's still relatively positive. But as far as this swing trading strategy, Fibonacci level is concerned, it's not great. You don't want to see either take it speculatively because it's above the 20-day moving average, and that's been tested twice before. So it could break significantly. As it was when we came down, bounce, and then broke significantly. So we could get in early, a small position, perhaps tomorrow if we follow through again for a break of that key level. But it might hold again. Where is it? It's at 90. Yeah, so it's at a key round number. It's at .9050. Look at that. I talk about zeros and 50s all the time. So I'm like, ta-da! And there we are. Fibonacci proving its incredible psychological way of predicting what may or may not happen. So these levels now become key targets for you if you're a long-term trader looking to hold this. So on this particular strategy, but the caveat is that the MACD is flat and nothing's happening. We've been we've ran out of steam. The big last candle was a big down candle. That's interesting, isn't it? So again, I mean, if you want to get you're a bit nerdy about it, you could put a little shorter time frame Fibonacci level on this last move here, and you can see where are the key levels. Well, interesting. Look where we are now. Look at that. As if I'd made this up like magic, isn't it? So the last leg here, the last intraday leg from whenever it was, the 3rd of February or the February. So the February distribution, if you like, the fib level for this particular asset, we are right smack bang as we speak at 90.50 or 90, wherever that price is now, 90.25. it's 50% of the move back to the upside from the big leg down we had on 2 days at the beginning of February. So we've recovered 50% of it. So the next resistance would be the 60. Sorry, it's not. It's the key golden ratio. It's the 61.8 level, and that is the 50 level of the. No, that's 61, isn't it? That's 50. I'm getting all confused now. What's that telling me? Well, anyway, you can see how these levels are they're sitting on top of one another. So these two levels here, these two green levels here, super important. We finished on Friday at this one here at 90.10. It looks like today it was stuttering around 90.30, the next key fib level. But the next upside target would be 90.52 on that one. So I'll just delete that last fib level. There we are. There's that key 38.2 of this big leg down. Still the first target level. It happens to be 50 of that last leg. Okay, so that's how to use fib levels either on their own or, I say, use an oscillator to confirm it. And if you're not going to use the fib levels as your target, as I say, here we're using or count back on the candles, which is sometimes a lot easier for people. So you can see with 2 strong days, so I'll be happy to have my stop loss sort of around about there, or even at the bottom of Friday's close or a bit lower. You can use the let me show you the rule using the so say we got in here today. This is I'll say we got in yesterday on Friday night on the break back up of the 20 day moving average. A strong big body candle, that's positive. We've broken the 20-day all week. We tested with it, so that's positive. The MACD, actually, if we drill down in here, you can see it's just about it's holding above zero, like it's turned green again, and we've got a bit of diversion in the MACD and the signal line itself. So that would be our stop losses there, where the ATR 10 is about call it 58. So 1.5 times 58 is what's that? 20, 78, 80, 84 pips. That would be, so our stop loss from this entry would be 0.84 below here. So it would be round about here anyway as well on the countback rule. So 1.5 times that 10 ATR, our stop loss would be there. And we're in the money today with a key level or first target there, second target perhaps there. Or again, as I say, let's do the fib level here. I've got it zoomed up a bit more to see that a bit better now, can't you? A break of this, that's the last leg, so that's a key resistance there, that 50 at 92.25. So nice break, a heavy. More action to the upside today would be positive for our target to take us to that 38 there at 90.50. So there we go. Trading with Fibonacci, swing trading. Again, the key with Fibonacci, guys, let me take that one off, is checking is the trend finish. We only knew, I was only confident to put that on. Obviously, this is days and days after it's actually finished, but that's quite a nice leg there, isn't it? But you can see we've run uninterrupted, unhindered from the low here at middle of January to the first key fib level at 38.2, the 23.6 I've taken off, but I guess it's round about there where these lows sit as well. Okay, so five swing trading strategies for you there. It's different to day trading, as I said last week, and investing, long-term investing. You're looking for the turns. Technical analysis, as we just demonstrated, hopefully I've just demonstrated, is great for swing traders. Timing is key. We've got this A, B, C, D, 1, 2, 3, 4, 5, impulse, retrace, ziggy zagness of the nature. Have a system, trade it, accept the results, whether you're winning or you're losing. Put the losers, analyze everything, spend the weekends doing that, bank your winners or when you're not trading, and repeat as often as you like. And if those losing trades are smaller than the winning trades, you'll make money, my friends. The trouble is, most of us, when we start, it's the other way around. Flip the coin, accept your losing trades, keep those winning trades comfortable. Swing trading, you need a bit of patience, let it run, and you're in the money. Okay, I've run over yet again. Apologies for that, but thanks for hanging around. So the last 2 sessions, we looked at 5 different strategies. The slide that was on trading books, my 3 favorite of all time still. Take some beating. So we've looked at what is a swing trader, this idea of liquidity, the time frame we're using, typically daily, have a systematic approach. What makes a good swing trader? 5 different strategies. We've used our simple moving average and RSI, the parabolic SAR and the MACD, a crossing exponential moving average strategy, the Bollinger Bands, looking for, a reversion to the midline and then going with the trend. Is there a trend on if the Bollinger Bands are angled? If they're flat, stay out. You can still try and trade the same sort of mean reversion, but you haven't got the benefit of knowing you're in a trend. You're knowing you're positive. You're above the midline or below the midline, but it's not trending. And then finally, we've used the retracement techniques on the should be of the it's a point. It should be a 0.8 there. It's missing for some reason. Of the Fibonacci levels. But anyway, there we go. Not to worry. I'll see you all again. There it was there. There it was there. The Fibonacci retracement trade did turn up 2 ticks away for some reason. See you tomorrow. Tomorrow is it's quite a busy week this week. We've got the PMI day on Friday. Obviously, US is closed today, so it's very quiet today. Canadian inflation tomorrow. We've got RBA announcement in the early hours of the morning. The event of the week is Wednesdays. Although the backward look in the Fed minutes, they always create some sort of reaction. So, big players might be looking to either buy or sell big assets on the background of that news sometimes. But, obviously speculate things have changed quite significantly since their last announcement. Many are talking about no rate cuts now, which is about $1 weakened 4 or 5 days now for the Fed this year. Most are still saying they're still looking to cut. Some are still talking about potentially 2 cuts, and obviously there's other participants saying they're going to hike rates or going to have to hike rates because of the inflationary impact of Trump's tariffs, and it's the unknown thing, isn't it? Markets hate unknownness. But anyway, we'll see what the Fed actually said, what was documented. That's why they're important, the minutes. It's because it's what's documented for perpetuity. Thursday, we've got the weekly claims. I'll begin in the evening at 7 o'clock server time, and then on Friday afternoon, we've got PMI day. The US PMIs come out a bit later. The European PMIs will come out a little before that, but I'll see you at 1:30 GMT Universal Standard Time on Friday for that. So take care, everyone. Thanks for attending. Stay safe, and as ever, may the pips be with you, my friends. All the very best. Be good. Have a great Monday evening. Take care. Bye-bye. Off to cook my wife dinner now. All the best, everyone. Bye-bye.